Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
September 1929, confidence felt unbreakable. Wealth seemed permanently ascendant. In Manhattan, a businessman sensed unease without clear evidence. Prices climbed, newspapers celebrated, yet intuition whispered that something was fragile. He chose caution over consensus, a decision history would quietly vindicate. On a Tuesday morning, he entered his bank with measured urgency. A passbook changed hands, a routine gesture carrying extraordinary consequence. Tellers counted bills, not digits on screens or delayed confirmations. Within minutes, his savings transformed into tangible, portable certainty. 2 days later, markets convulsed, shattering illusions of endless prosperity. Panic spread faster than understanding, fear replacing euphoria almost instantly. Crowds gathered outside banks, discovering trust can evaporate without warning. Access, once assumed permanent, became the central drama of survival. The catastrophe became legend, but mechanics were brutally straightforward. Excess leverage magnified losses, speculation collided with collapsing confidence. Institutions failed because reserves vanished, not because systems denied withdrawals. Choices determined outcomes more than infrastructure or administrative barriers. Nearly a century later, financial architecture operates on different principles. Modern stability depends on containment, friction, and carefully engineered delays. Liquidity exists within rules, procedures, and algorithmic risk controls. Freedom of movement no longer mirrors the simplicity of earlier eras. Retirement wealth illustrates this transformation with remarkable clarity and scale. Accounts promise long-term security, while discouraging rapid emotional decision-making. Penalties, taxes, and thresholds redefine ownership into conditional accessibility. Value remains visible, yet immediacy becomes subject to institutional processes. Banking itself reflects similar evolution beneath everyday digital convenience. Large cash movements trigger compliance protocols shaped by anti-fraud imperatives. Daily limits fragment retrieval, stretching access across time rather than moments. Calm conditions mask constraints that surface only when urgency intensifies. Market vehicles introduce another layer of complexity often misunderstood by investors. Funds rely on liquidity providers whose presence depends on stable participation. During stress, pricing diverges, spreads widen, and theoretical value becomes negotiable. What appears liquid may behave unpredictably when everyone seeks simultaneous exit. History has already provided modern rehearsals of this structural tension. Redemption gates, trading halts, and valuation uncertainties periodically reshape expectations. Investors confront delays not from insolvency, but from systemic risk management design. The distinction matters little when timing becomes the decisive variable. Underneath these mechanisms lies unprecedented speed-altering market behavior itself. Algorithms react to volatility with mechanical precision and relentless consistency. Feedback loops accelerate movements once moderated by human hesitation and judgment. Time compresses, transforming gradual corrections into abrupt, destabilizing cascades. Leverage compounds this dynamic, frequently embedded beyond ordinary visibility. Derivatives, structured products, and collateral chains amplify both gains and fragility. Unwinding unfolds rapidly when correlations shift or confidence deteriorates unexpectedly. Stability depends on participants acting predictably within inherently unstable environments. Infrastructure, though technologically advanced, introduces its own subtle vulnerabilities. Digital settlement networks require continuous function, synchronization, and operational confidence. Surges in demand expose bottlenecks invisible during routine transactional flows. Modern finance thrives on connectivity, yet inherits dependence from that very design. Episodes like Silicon Valley Bank reveal contemporary speed and sensitivity. Information traveled instantly, reactions synchronized, withdrawals concentrated within hours. Regulatory interventions stabilize outcomes, but access briefly vanished for many participants. Confidence proved as decisive as capital, liquidity, or formal solvency measures. Policymakers respond with tools shaped by lessons from previous disruptions. Safeguards seek systemic continuity, often prioritizing stability over individual immediacy. Containment strategies attempt to prevent cascades that destabilize entire economies. Yet each safeguard subtly alters the relationship between ownership and accessibility. The enduring pattern is neither conspiracy nor inevitability, but structure. Financial systems balance freedom and stability through evolving layers of constraint. In crises, these trade-offs become visible, personal, and emotionally charged. Assumptions dissolve precisely when certainty feels most desperately needed. 3 lessons emerge from comparing past simplicity with modern complexity. Liquidity is conditional, speed magnifies outcomes, and psychology drives systemic turning points. Preparation favors understanding mechanisms rather than predicting precise moments of rupture. The question is not fear, but awareness of how rules behave under stress.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.